Welcome back. The last time we spoke, we discussed the U.S. Treasury markets and the inverted bond yield that has occurred, and we can see with updated figures. Zooming in over here on the comparison of 30 and 20-year maturities, we have now a 0.22% divergence, where the 20-year bond pays 3.44%, and that's a 20-year bond, and 30-year bond pays at 3.22%. And again, in what we call normal economic conditions or normal growth cycle, we'd expect the longer-term maturities to have a higher bond yield than the shorter-term maturities. Now, with that said, I thought it might be helpful to take a look at how our bond yield has progressed over the course of the past few months, since January, actually. Now, the top right-hand corner, this is January, February, March, so on. Now, the axis for each one of these is the 1 month maturity all the way up to the 30-year. Now, in January, we can see, for example, this is what's considered to be more or less a normal yield curve, at least until the end, where the 20 actually declines down to the 30-year maturity. But generally speaking, in a normal, what we consider to be a normal growth cycle, the longer the maturity, the higher yield. Now we can see, and it's supposed to be more or less a smooth diagonal line upwards. In February, we can see that the 10-year really starts to decline and represents more of a drop than it did in January. It flattens out in March, and the rule of thumb is flat yield curves cannot continue to exist. There's no logical reason why an investor would buy a 20-year bond that pays the same as a 10-year bond. Why take the risk? Take the shorter maturity if it pays you the same kind of yield. In April, this trend continues. We can see the 10-year bond yield actually drops below the prior 7-year maturity. This trend continues in May. In June, it becomes even a little bit more steep. In July, it flattens out quite a bit, where you're getting literally the same yield for a 6-month bond all the way up to a 10-year. And then only in August does this yield become very, very dramatic, where we have the highest yield occurs on the 1-year bond, declines down to a low of the 10-year bond, and then moves back up higher. And the interpretation of this is as follows, is that as investors and as the bond market overall expects trouble, economic trouble in the future, investors are less likely to hold longer term maturities and tend to put their capital in shorter term maturities. Now, again, a flat yield curve, which looks like emerged in July, is something that cannot naturally just continue to exist. So we expect that a flat yield curve is either going to straighten out and look more like a January yield curve, which is normal, or an inverted yield curve, which is August. Now we're going to continue to watch as these charts develop, especially in September and towards the end of the year, to determine if this yield curve, this inverted yield curve, becomes more steep. If it's the case, those numbers suggest we may see a reversal in equity markets, or if these yield curves revert back to a January type of shape, then we may expect equities and economic conditions to improve even to a greater extent. Hope this has been helpful. We'll see you again real soon.